Hello, I'm Cindy Fernelli, Executive Director of the Center for Audit Quality. The CAQ is a public policy organization dedicated to enhancing investor confidence in the work of public company auditors and our capital markets. One of our objectives is to convene and collaborate with other stakeholders to advance the discussion of critical issues. I'm here today with Michelle Hooper, an independent member of the CAQ's governing board and a member of the board of directors of the National Association of Corporate Directors, as well as other corporate boards of directors. Michelle led an important CAQ effort on financial reporting fraud, which we are about to talk about.
Hi, Cindy. It's nice to be here. Well, the Sarbanes-Oxley Act has done much to improve corporate governance and to deter fraud. However, financial reporting fraud and intentional material misrepresentation of an organization's financial statements remains a serious concern for investors and other capital market stakeholders. In 2009, the CAQ convened 4 roundtable discussions on the topic in the United States and 1 in the United Kingdom that were attended by more than 100 individuals. On October 6th, the CAQ issued a report entitled Deterring and Detecting Financial Reporting Fraud, a Platform for Action. It pulls together the perspectives of discussion participants, including corporate executives, members of boards of directors and audit committees, internal and external auditors, investors, regulators, and academics, as well as related points to ponder. Cindy, let's begin with an overview of the report's key observations.
Discussion participants identified 3 conditions, referred to as the fraud triangle, that typically combine to lead individuals to commit fraud. The first is pressure. Pressure whether to meet short-term financial goals, hide bad news until losses are recouped, or achieve personal gain. The second is perceived opportunity, the opportunity to get away with fraud because of weak internal controls and/or culture. And the third is the individual's ability to rationalize fraudulent behavior. In most cases, financial misstatement or manipulation begins on a small scale, perhaps with an adjustment to an account. But the need to maintain the deception continues, and the perpetrator is locked in, loses objectivity, and leads down that slippery slope to commit major fraud.
To your point, Cindy, CAQ discussion participants identified 3 themes to mitigate those conditions. The first is a strong ethical tone at the top that permeates the entire corporate culture. The CAQ roundtable participants were unanimous in the view that the organization's ethical culture is a decisive factor in mitigating financial fraud. A strong ethical culture is one that permeates throughout the company, establishing an expectation to do the right thing, counteracts pressure and incentives to commit fraud. Management and line supervisors play a critical role by implementing clear policies and messaging their expectations. Just as important, they must visibly demonstrate ethical behavior because actions speak louder than words. Boards and audit committees play a key role in reinforcing the tone at the top by making ethical conduct an overriding priority.
Tone at the top is reinforced through a comprehensive fraud risk management program that includes effective controls. An important element of a comprehensive fraud program is a readily accessible, confidential whistleblower program. Studies show that fraud most often is detected through tips. In multinational corporations, it's important for fraud risk management programs to take cultural differences into account.
Complementary roles are played by internal and external auditors. Internal audit tests and monitors the design and effectiveness of fraud programs and internal controls over financial reporting, while external auditors have the responsibility to plan and perform an audit to obtain reasonable assurance that the financial statements are free of material misstatements, whether caused by error or by fraud.
The second key theme identified by discussion participants is skepticism. Skepticism requires a questioning mindset that leads to professional objectivity and an attitude of trust but verify. It involves promoting a cultural expectation that the questions posed by management, the board, the audit committee, and internal and external auditors all are probing and appropriate without creating a hostile environment. Skepticism helps validate information through probing questions, critical assessment of evidence, and attention to the red flags or inconsistencies. Care should be exercised to achieve a balance between a natural bias toward trusting management and colleagues and recognizing that those who commit fraud often are individuals who are known and respected by colleagues. All participants in the financial reporting supply chain need to apply skepticism in discharging their respective responsibilities.
Audit committee members should be especially sensitive to and monitor for the possibility that management may override controls in order to commit fraud. Internal and external auditors already are trained to apply skepticism as an integral part of the conduct of their duties, including the consideration of risk of management override of controls. The third key theme that emerged during our discussion is communication. Financial reporting supply chain participants have complementary and yet interconnected roles. Fulfilling those roles can best be achieved by proactively sharing information and by identifying gaps in fraud monitoring. The Audit Committee is the hub for many of these communications because it has direct reporting lines from management, the internal auditor, and the external auditor. Regular and open two-way discussion between these groups should be the norm. There also should be regular communication between management and both the internal and external auditors. From my experience, they also can be useful sources of insight based on their knowledge of the company and their experiences at other companies. Regular, robust, and open communication enable the sharing of information, perspectives, and concerns that provide a view into the company that is greater than the sum of the parts.
We hope the report provides food for thought and spurs all stakeholders to leverage existing resources to advance the deterrence and detection of financial reporting fraud. I'm pleased to say that this report is just the beginning of our anti-fraud stakeholder dialogue. Those who took part in the discussion agreed that while the supply chain participants work to deter and detect financial statement fraud one company at a time, a collective sharing of ideas and resources would greatly advance efforts to mitigate financial reporting fraud. As a result, we've reached out to Financial Executives International, the Institute of Internal Auditors, and the National Association of Corporate Directors, all of whom have offered to help partner with the CAQ in these important efforts. And we welcome the involvement of other interested stakeholders.
Based on the observations highlighted throughout the CAQ's report, our initial collaborative efforts will focus on 4 broad areas: advancing the understanding of the conditions that contribute to fraud, promoting efforts to enhance skepticism, moderating the risks inherent in focusing on only short-term results, and exploring the role of technology in deterring and detecting financial fraud reporting.
The CAQ is committed to working with our partner organizations and others to find ways to improve efforts to deter and detect financial statement fraud for the benefit of investors and all participants in our capital markets. Michelle, I look forward to our continued collaboration. Thank you for your leadership on this really important initiative. And to all of you watching, thank you for joining us at this important discussion. A second video, which discusses our collaboration in detail, is also available on our website, and I invite you to view that as well. Thank you.